Another shockingly good jobs report blowing past Wall Street expectations. January saw a whopping 353,000 jobs added to the economy, well above the estimate of 180,000. The unemployment rate held steady at 3.7%, below the 3.8% forecast. We also saw November and December revisions showing 126,000 more jobs added than previously reported. Joining me now is Charles Schwab Managing Director and Chief Investment Strategist Liz Ann Sonders. Also, I should add, excellent Twitter or Xer correspondent, whatever we say these days.
Thank you.
A lot of nonsense on that channel, but your charts are great. People should check them out.
Thank you.
So last month, we could look past a pretty strong headline number and find some weakness. But the January report released Friday was pretty strong on most counts. What jumped out to you?
So it was really hard to nitpick. It was actually pretty easy to nitpick with the December jobs report, but not the January jobs report. If you absolutely had to, you could point to another decline, consecutive decline in household employment. That's the survey, the household survey from which the unemployment rate is generated. And it was a fairly limited decline, but that is the second month in a row. And then hours work continue to come down, and that's often a leading indicator. But aside from that, not only were the headlines positive, but as you pointed out, the revisions were quite positive too, which bucks a trend that existed for much of last year.
And what did the wages number tell you? Everyone's watching that one real carefully.
Yeah, wages up again. Now, weekly hours down and weekly wages were not as strong, but I think the hours down piece may have had something to do with the incredibly cold weather, especially relative to a year ago when you had a bit warmer weather. So wage growth strong, but the hours piece might have been biased down a little bit by virtue of the weather.
Now, of course, everyone looks at these numbers and thinks, okay, what's the Fed going to do? This probably took a March rate cut off the table.
Yeah.
Then you get to May. So we'll see what happens there. But what do you think of this theory that the Fed doesn't want to do anything too close to the November election? Does that affect Chairman Powell's thinking?
I doubt it, but I'm not inside his head. I do truly believe in the independence of the Federal Reserve. He has increasingly, I think, felt compelled to address that because he's starting to get asked questions about it. There have been plenty of instances in history where either loosening was occurring or tightening was occurring during a presidential election. Now, admittedly, in most cases, it was already underway and it just persisted through the election period. There is some chatter about if they don't cut by June or July, would the inclination be to wait? But again, I have no idea. I also think it's premature to be just switching the bet from March to May because you have a Fed that is expressively data dependent. So much as it depended on the data between now and March, and to your point, I think the January jobs report essentially took completely off the table what Powell kind of took off the table at the most recent Fed meeting. But to suggest that therefore it's one meeting later, the data will dictate the timing of cutting.
I want to ask you about investing, but one more economic question. Productivity numbers have not been good for quite a while. Recently, they've looked a little bit better. Is it too early to say that's a trend, or do you see any glimmers of hope there?
Well, in the very short term, productivity can be fairly volatile. I think in general, we're probably looking at a pretty decent productivity backdrop. And the nice thing about those most recent productivity numbers is they were not only significantly higher than expected, but labor costs were quite a bit lower than expected. And that's obviously the spread that you want: higher productivity, lower unit labor costs. And that accrues ultimately in an aggregate sense to the benefit of profit margin. So when I think in longer term, I'm optimistic about profit margins as well as profitability and productivity. Not that it's not solely a function of AI, but I think companies are really investing around productivity enhancements and efficiency, and I think that will accrue to the benefit of a metric like that.
So one more question before you go, and that is, how do you add this all up to an investor portfolio? Any opportunities out there maybe the market's not fully pricing in?
Well, I think one of the things you're seeing happening is last year, particularly from the July point forward, you saw even the major indexes like the S&P and the NASDAQ move directly, basically contrary to what bond yields were doing. The corrective phase in equities occurred when you had bond yields go from under 4% to up to 5% in the case of the 10-year, vice versa, you gave a lift to the major averages when bond yields plunged. Now I think the volatility in bond yields, and you certainly saw some in the aftermath of the jobs report, I think is having more of an impact down the capitalization spectrum in indexes like the Russell 2000, because that's where there is more exposure to moves up and down in yields for those smaller companies, certainly the zombie companies that are more at the mercy of the changing yield environment as they have to come to the credit markets as they look at some of their debt coming due. So I think there's a bit more of a nuanced way you're seeing the impact of bond yields on equity, and I think that's going to persist. If you want to move down the cap spectrum, I think there are opportunities, but stay up in quality. Do not sacrifice quality.
And avoid those zombie companies. I think the literal definition there is a company whose cash flow is not enough to cover its debt service. We'll avoid those. Thanks, Liz Ann.